So my name's Gerard and I'm Head of UK Design and Strategic Risk at Schroders Solutions. And I'm going to take us through some thoughts around the strategic rationale for why you might want to invest like an insurer. So thinking around the philosophical points that you might need to get comfortable with, think about how you may talk about risk, and also are there things around how do you integrate into a journey plan as part of your overall investment strategy. But if we take a step back to begin with and think about where a scheme's actually going. Now, most pension schemes are obviously focusing on their technical provisions because that's the basis that determines sponsor contributions into the plan. But increasingly, schemes have been thinking about where are they going beyond that, thinking about their longer-term target. And indeed, they'll be required to do this under the proposed new funding regulations that are due to come in later this year. But it's not just a binary decision. So it's not just a choice between running the scheme off in a low dependency or self-sufficiency way or buying out as quickly as you can. There's a spectrum of options between the two. Now, all of these tend towards buyout at some point. Ultimately, the cost of running the scheme will outweigh the buyout premium at some point. But it's a question of time horizon, and making sure you choose the right solution that's appropriate for your scheme is important. So if we think about that time horizon question, because schemes have seen a significant improvement in funding level over the past 12 months or so, particularly driven by the increase in gilt yields towards the end of last year. And that means schemes have seen that improvement in funding position. How are they going to choose to respond to that? Now, recently we undertook a survey with the PMI in association with Schroders, asking schemes how they may respond to this improvement in funding position. And perhaps surprisingly, 3/4 of them thought that rather than reducing the time horizon, they'd actually take a lower for longer approach. So a lower investment return, but keep the time horizons perhaps more aligned with where they thought they were going to be prior to the improvement in funding position. I'd say that's potentially a surprising outcome. But another question within the survey provided a little bit of insight as to perhaps where those thoughts had come from. So what's shown here is respondents were asked, what are the potential barriers to buying out with an insurer in the short to medium term? And there's a range of outcomes shown here, but perhaps the ones you might expect around data quality. So is the data adequate and appropriate, and do you have all the member details correct and all those sorts of things? GMP equalisation, the gift that keeps on giving, is perhaps another obvious reason why schemes might take a little bit longer while they resolve those issues. So one in the middle is quite interesting, I found. So the sponsor and trustees having a different opinion or not necessarily agreeing with what the most appropriate long-term target for their pension schemes are. Now, this might lead to some interesting conversations over the coming months as, again, the new funding code is going to require sponsors and trustees to agree where schemes are going. So there could be some difficult conversations ahead there. There in purple on the on the left-hand side here, insurer capacity. That's a very valid question. It's something we're going to look into a little bit more detail now. So what this graph is showing is the volume of bulk annuity transactions across the UK pensions market over recent years. And by and large, you can see there's a trend upwards increasing in the volume of transactions over the past 5 or 6 years. 2019 was a bit of an anomaly. There was the bulk transfer that was at the time the biggest transaction with the Telnet pension scheme. But overall, you can see trend upwards towards around about 30 billion or so of activity last year. And indeed, given the change in gilt yields, that's potentially more aligned with the 2019 figure after you allow for the impact that has on scheme liabilities. But where might that go from here? Well, 2023 has already got off to a strong start with a new record transaction occurring with the Royal Sun Alliance pension scheme insuring 6.5 billion of their liabilities already this year. But looking beyond that, generally there's an expectation or belief in markets that this could potentially more than double over the next 5 years. That's as a function of insurers, solving resourcing issues, using new technology to deal with capacity constraints for quotations, sourcing new assets to fund the new business. But even if they do achieve those sorts of levels of outcome, then actually that's still only about 5% of the total DB assets out there in the market at the moment. So even if we do see a step change in the capacity within the insurer market, it's still a relatively small part of the overall DB universe, and actually schemes may well find, so that may well be a valid concern from the previous chart, the survey response for schemes may have of insurer capacity. So the question was, should a scheme invest like an insurer? So the obvious first question to address is, well, what does that look like? So what we see on the screen here is analysis we've done looking at the book of assets that insurers have supporting their annuity business. And the first thing to note from this chart is they're all different. There is no single portfolio of assets that you can hold that says, right, if I hold this, I'm matching annuity pricing, I'm doing what an insurer does. But there are some key themes in here that's well worth drawing out. So the white bars on the left-hand side here, those are gilts and other government bonds. And the purple area are investment-grade corporate bonds as well. And you can see that across all of these 8 insurers shown here, that pretty much all of them have at least 50% in these 2 asset classes. And even if you look at the assets towards the right-hand side of here, corporate bonds, infrastructure debt, real estate or property loans, equity release mortgages and so on, they're all credit-type assets or what's known as contractual assets, where the returns you get, the cash flows you get from them, are sort of predetermined in advance. And as long as the issuer doesn't default, you know exactly what you're going to get and therefore the level of return you're going to get from them. So whilst there may not be a common or standard portfolio you can aim for, there are some common themes. An overall, a lowish return target, extensive use of credit and these contractual type assets. And that's when we speak about investing like an insurer, these are the sorts of themes we're talking about. So what might that mean for a pension scheme? Well, if we start looking at how schemes have traditionally invested using a growth and matching type approach, and if you have a lower return target, this is illustrating a gilts plus 1 type return target, then you may have 25% of assets in a well-diversified growth portfolio and 75% in LDI. And that provides a good level of diversity across different asset classes. It provides a large allocation to support an LDI or hedge ratios to protect yourself from interest rate and inflation risk. And that, as a result, you have low volatility against a gilts-based discount rate on your liability measure. But instead, if we were to look at what that might look like for a scheme adopting an insurer-style approach, and you can see the breakdown looks a little bit different. So rather than that 75% in LDI, something close to 50% for the same level of return target. But the rest of the portfolio, the other 50% or so, is made up of these investment grade and other credit type assets in the portfolio. So delivering the same return, but the way it does that in a very different way. So the rationale, and obviously we'll explore this in a little bit more detail shortly, but is to focus on giving you greater certainty over the journey. It does mean you're less diversified in terms of the level of assets you have. And as a result, you may see more volatility on a day-to-day basis on things like funding metrics. But that can be addressed through things like the use of the discount rate you use to measure your liabilities. So if we were to adopt this insurer type approach, or what's known as a cash flow driven investment, or CDI, there are some philosophical points that you as a trustee board would need to get comfortable with in doing so. So as I mentioned, it's a different approach. It's all around having the cash you need to pay members' benefits when you need it. And that's a different approach to focusing on delivering a particular level of return and short-term funding volatility. I mentioned that there's a restricted class of assets being used, so you lose some of that diversification across asset class. But in return, it's focusing on the quality of assets you do have within the portfolio. Also, that risk point, I'll explain this in a little bit more detail in a moment, but actually, traditional metrics such as value at risk are perhaps less relevant under this approach. But the journey planning point is an important one, and again, I'll explain this in a bit more detail shortly. But fundamentally, building a portfolio of assets that are expected to pay off in a defined way over a particular time horizon can be very well aligned to your journey plan towards those longer-term objectives, whatever that objective may be. So the key thing to remember is CDI, or cash flow-driven investment, this insurer-type approach, is very much around providing certainty over the duration of your journey rather than the day-to-day volatility that has been the main focus under a traditional gilts matching and growth portfolio. If I come back to this point around the risk and how that manifests itself over time, what we've got on the chart here is an illustration of a range of potential returns from different styles of investing over the next 10 to 15 years. So if you had a, say, 10 to 15-year journey, what might your range of outcomes look like? And in the purple lines here, we've got the traditional growth and matching type approach. And for a low return target, as you might expect, there's a relatively narrow range of outcomes from year to year in terms of the returns you might receive. But actually, if they accumulate over a period of time, and we're looking sort of 10 plus years out into the future, that even only being a little bit out year on year could result in being quite significantly out over the life of your journey. Now, the alternative way, this insurer or CDI style approach, is shown in the white lines here. And what you can see in the early years is you may see more volatility. Now, that's a function of using credit. Credit has duration or sensitivity, is sensitive to interest rates. And so actually, you may see more movement in the value of your assets in the short term, remembering they're still paying out the cash you need when you need it for members' benefits. But in terms of sort of capital values, you may see more volatility. But because they're contractual assets, actually, you know what you're going to receive over a defined time horizon. So any gains or losses on a mark-to-market basis in the early days will come back to you over time. So actually, the key determinant of what the outcome is over the life of the journey is much narrower, and that's driven by your ability to avoid defaults from the issuers who've issued the debt you're investing in. So a very different risk profile depending on the approach, but that much greater certainty over a time horizon is the key characteristic of this style of investing. Now, if you thought that that all makes sense, that you can see the value in this, how might you think about introducing this into your portfolio? And it probably doesn't make sense to try and do that all in one go, one big hit, and actually phasing that in over a period of time and using this approach I mentioned, that it naturally aligns with journey planning over time. So what's illustrated on the screen here is a scheme with a return target shown in the blue line here that starts off at gilts plus 2 and trends down to gilts plus 1 over the next 7 or 8 years or so. Now, to deliver a gilts plus 2 style return, you're going to need a mixture of different assets, and in particular use some more traditional growth assets, sort of well-diversified growth funds in the portfolio to start off with. And then you can see in the mauve and the pink in use of credit assets and these contractual type assets in the portfolio, and the purple at the top here is LDI, and that everyone's familiar with. But by constructing the portfolio in the right way, that's going to evolve over time. So you have assets that are paying out cash flows. The actual sort of mix between the different assets will evolve over time as well. And if you put those together in the right way, they can very well align with your journey plan towards your ultimate long-term objective. And actually, you can therefore fit those together in a good way to provide you this picture without trading assets and potentially being forced to sell those assets at inappropriate times. So the key thing is thinking about that design, thinking about how that will evolve over time, and making sure that it's aligned with your journey plan, but also retain the flexibility you're going to need over time as well. Because with the best will in the world, the best planning in the world, things can change. You might get a new CFO come along and has a different view on what the long-term objective for the scheme is, for example. So actually making sure you design this in the right way and working with a trusted partner who can work with you to build in the flexibility you need while still having the right characteristics is an important part of the design process. So just to conclude, really thinking about should you invest like an insurer? Well, fundamentally that's determined by each scheme and its particular circumstances. There's not a single answer I can give to that question. But what I would say is that if you are considering a lower for longer style approach, that is consistent with how insurers invest. And there's a reason they invest in that way. So yes, it does require some different thought process around philosophical points like your approach to risk measurement, focusing on having the cash flows you need to pay members' benefits when you need them, rather than that volatility of funding level or short-term metrics such as that. But if designed in the right way, it can have natural alignment with your journey plan and that path towards your longer-term objective over the coming years. And again, if designed in the right way, that it can be suitable for a broad range of different end games. It can be appropriate whether you're focusing on a low dependency run-off style basis or a buyout type target over a given time horizon. And again, building that flexibility you need into your portfolio construction ensures that you're not locking into a specific end game target right now. So with that, I'll just conclude by saying that an insurer style basis, the CDI style basis, is very much driven by It's a total portfolio approach. So that point I mentioned earlier on with illustrative portfolios, that it's the whole portfolio that's helping towards supporting your hedging target, for example. You need to consider the entire portfolio as one entity, not different elements of LDI and growth, for example. But done in the right way, it can very much meet the needs of many pension schemes as they approach the later stages of their journey plans.